The dollar index from the peak has corrected about 5-6 odd percent. Do you think at some point we're closer to the FII sentiment turning than what we were, say, 10-15 days ago?
The good thing is in Indian markets that the dependence on foreigners or foreign flows has come down considerably.
How would you say one should allocate their money given the sort of uncertainty that we are seeing in the globe?
Technology is changing at a very fast pace, and there are some sectors which could get impacted. But interestingly, if you look at the Nifty composition, very little of Nifty is really exposed to that risk.
Hello and welcome to Navigate with HSBC, a podcast series where we dive deep into investing and market trends that help you make informed decisions. Today, we will explore the current market landscape, risk management strategies, and the evolving role of alternative investment funds. And joining me for this discussion is none other than Prashant Jain, the founder and CIO of 3P Investment Managers, a legendary seasoned investor who's navigated multiple market cycles, created a serious amount of wealth for all his investors. Thank you so much, Prashant, for joining in. It's an absolute honor and a pleasure speaking with you. No conversation with you can start without asking you, what do you feel about the market right now? What's the situation like? Because we've seen a fair amount of froth being taken off, particularly in the mid and small cap space.
I feel as far as large caps are concerned, they are offering decent value. And I would suspect that the risk reward is now favorable. When markets can always surprise you on the upside or downside, but I think the downside, barring some unforeseen developments, should be quite limited around here. If and when foreign selling subsides, I think it will at some point of time, then that would also be quite positive for the markets.
So would you paint all the large caps with the same brush, or would you differentiate between large caps as well?
I think in large caps in this market, the variance in valuations across sectors is actually quite small.
Okay.
And the dispersion in valuations is quite small. So I would say there are no sharply overvalued or undervalued sectors in large caps. However, in the small mid cap space, I think despite the meaningful correction that we have seen, I think valuations are still higher than comfort. I think the pace of underperformance will come down probably compared to what we have seen in the last few months or quarters. But I think there is considerable room for derating still in that space.
Typically with the dollar index and the FII sentiment turning, the dollar index from the peak has corrected about 5-6 odd percent. Do you think at some point we're closer to the FII sentiment turning than what we were, say, 10-15 days ago?
I think yes, though we cannot be sure. But the good thing is in Indian markets that the dependence on foreigners or foreign flows has come down considerably. See, a bigger change has taken place and money is being raised in the primary markets should go down very substantially in the future compared to last 6-9 months, 12 months. Because on most of the issues in last few quarters, investors have not really made money.
Right.
So I think the appetite there is quite small. And therefore, if that pipeline or that supply shrinks, I think there will be increasing money available for secondary markets. So even if foreigners continue to sell for a while, I think it's okay because local institutions have very large sizes, continuous flows, and I think we should be in a position to absorb that.
In the large, mid and small caps across the board in the market, there are sectors which are, more prone to disruptions because of technology, more prone to disruptions because of what happens in the globe. In that regard, how would you say one should allocate their money given the sort of uncertainty that we are seeing in the globe?
Technology is changing at a very fast pace, and there are some sectors which could get impacted. But interestingly, if you look at the Nifty composition, very little of Nifty is really exposed to that risk. I mean, 35 to 40% is banks, NBFCs and financial services, insurance, etc. That clearly, I don't think there is much that type of a risk there. Another 10 to 15% is consumer staples plus tobacco. That again, not much of a risk of that nature. 8-10% is roughly capex.
Right.
That again is not exposed to that risk. Then you add companies in energy, petchem, telecom, pharmaceuticals, cement, metals. These are also not exposed to those kinds of risks. So what is essentially left is software services. I think by definition, by nature, these companies have dealt with multiple technology changes, cycle changes over last 3-4 decades. We can assume that they are aware of what is changing and they are taking appropriate steps. So I really don't know how this AI or other technological developments will impact these businesses. I would assume the impact should be, if not positive, on the downside, it should be minimal because they have the ability to evolve, to retrain their employees, and their cost structures are also pretty variable in a sense.
Wonderful. That's why they call you the legend, right? That was a truly insightful conversation. Thank you so much for your time, Prashant. We hope our listeners gained valuable perspectives on the market, investment opportunities, understood the difference between mutual funds and alternative investment funds as well. We'll be back with another episode of Navigate with HSBC. Thank you so much for watching.